So welcome back. Today we're going to be discussing about the different ways you can register your business and what are the tax implications on that type of registration. I think as an advocate, this is a question I get asked a lot. People who are right now, we are more in tune, more sensitive to how we shall pay taxes. We want to make sure that even as I register my business, I want to know that I am in the most tax efficient that this is the most tax efficient way of registering my business. So, I mean, there are so many different ways that you can register. We have, first of all, you have your for-profit and then you have your non-profit businesses, and each of them sit on their own tax regimes. And for profit, I think we see a lot of business names, which are mainly sole proprietors and partnerships. And then again, we see a lot of people now are taking up a lot of limited liability partnerships. We have a lot of companies also being registered. So mainly around the for-profit area, you will see those three in my experience. And then beyond that, we have also for the non-profit, I'm seeing a lot of people registering companies limited by guarantees. I'm seeing a lot of societies being registered and a lot of NGOs also. So maybe less of NGOs, people are moving away from the NGO regime and moving more towards the company limited by guarantee regime, because it also has its own, registration and compliance issues that are unique to it. And I think maybe one of my first things is questions that I'm always asked is, so these are the different options that I have. How will I pay tax on these different options? We were discussing LLPs, and maybe we can use that as our jump off point. And there's an idea, how do LLPs pay tax? How do partnerships pay tax? How do business names pay tax? Or what is the tax regime that they're supposed to be under? Yeah.
Thank you, Angela. Any form of business is subject to tax, and because taxation is on gains that are earned in business. So different formations will have different nuances around how tax then is calculated and what obligations again are due on them. Sole proprietorships, which are the simplest and very common in business today. Many people go into them thinking, because it's not a company, there's no tax, but there's a tax implication because there's a business running and there's a gain out of the activities that are done on it. And that gain that is on the business of a sole proprietor is then taxed on the sole proprietor, on the individual themselves. And this taxation again will be subject, just like other individuals, to some graduated scale on that. We have other forms of registrations. Like now, let's talk about the partnerships and the LLP, which is becoming very, very common. Yeah. So again, it's a form of business registration. It will run its business, it will record its incomes and its expenditures, and will have a surplus at the end of the period. Again, that's the surplus that will be subject to taxation. However, this is attributable to the partners, and the partners then will pay the tax on this surplus.
So can I ask a question? Just sorry to interrupt you there. So if I'm running an LLP and I have a surplus at the end of the year, and we decide not to take it out, do we still pay tax on that surplus? Whatever we leave inside the business.
Yes, from an accounting and a taxation perspective, it's not about drawing the amount. It's that the amount has been earned. So it has to be apportioned. And this will just be on the books, not necessarily being removed from the business. In fact, the partnership could make a surplus for the year that can be apportioned to the partners, but there's no money. There's actually no cash to pay it out. So that is still subject to apportionment and tax on the partners.
Yes. So then it's apportioned according to the percentage of the partnership.
Yes, which is the percentage of the partnership ownership.
Yeah, of the partnership ownership. Because we also know, even when we're registering, sometimes you have one partner can have 60%, another 20, another 10. So you will actually be according to what your portion is in the partnership.
Yes, surpluses will be apportioned based on percentage of ownership of the partnership. And so that's, again, the implication of taxation on that.
Right. And then what about corporate tax in terms of what would I pay? So I'm running my business, I'm a company. What am I supposed to be paying? Is it a flat 30%? Is it graduated? What happens? with that?
Okay, as a company, as a limited liability company, the tax rate is currently 30% for resident companies. And it's a flat 30% on the profit.
Okay.
So you would need then to assess what the incomes were and what the expenses were. And then on that profit, it's a flat 30%. And this 30% again accrues over the year. And therefore, you need to be aware of installment taxes. Many businesses sit and wait for the close of their financial year, and they know they have a 6 months period within which to file a return, and they pay tax when they're filing the return. And now what they notice is they're getting penalized for that.
Okay.
So for companies, you should be on an installment tax perspective. Even for an individual, you should be on an installment tax perspective.
Okay, so I think that's interesting. When you're talking from a perspective of a sole proprietor and a partnership, I think also it's good for that clarification. There's an assumption because I'm running a business, then I'm subject to 30% tax. But that's not the case. I think it's graduated as per income, as per the income level.
Yes, for individuals, taxation on income is on a graduated scale, similar to what is used by employers on their employees for PAYE. So it's a graduated scale. So the lower, a first tier of income will be taxed at a lower percentage of 10%, and the scale graduates to a maximum of 35%.
Oh, okay. So then as an individual, I'm even being charged more than as a company. Technically.
Yes, depending on how much you're earning. At the higher rates, if you're earning higher salaries, then there's an amount that will be subject to a higher tax than a company.
Okay, I think that's a lot of clarity. I know there are a lot of tax incentives. I don't know whether they're still applicable, but there's some tax incentives for businesses, and I think a lot of times small businesses do not tap into some of these tax incentives, and I don't know whether there are any quick ones that we can learn about, or it depends on the industry. Maybe putting you on the spot here, but I don't know whether there are any tax incentives that you can sit down and say, you know what, for a small business, these are some of the tax incentives that you need to think about, and how do you apply to get them?
Tax incentives, actually, the first tax incentive is that you need not pay tax on all your income. You pay actually on your surplus or your profit. So the first incentive the Income Tax Act gives you is to actually deduct relevant expenditure that was incurred in generating the income. So this takes us back to where, one, recording your transactions is very important, and then two, running your business in a compliant way, having the right documentation, which is invoices that are compliant, that you can actually use to reduce, deduct from income to arrive at a profit. Now that's the first big incentive that you get. Other incentives like wear and tear, where the Income Tax Act does actually acknowledge that assets that are owned by the business and utilized by the business in the generation of revenue depreciate, and therefore you get a wear and tear allowance, which then comes in to reduce the profits and therefore the subsequent taxes that you get to pay. So those are some of the ways in which you can actually take advantage of some of those available avenues to deduct expenditure.
And then I think the other one is, we've just talked about non-profits. There's a lot of misconception around when I register a non-profit, it means that I will automatically not pay tax. That there will be no tax assessed because I have registered a non-profit. So I've registered a society, nobody is going to tax me. I've registered a company limited by guarantee, nobody is going to tax me. So I may be doing activities that look like I'm running a business inside that structure, but KRA will not come to tax me. And I think it's good for us to clear that up. So when I'm registering as a non-profit, what are some of the key things I need to do or to consider so that I actually do enjoy that non-profit status?
Yes, that's a very key misconception that is there, that once you register the not-for-profit, you don't even need to file a tax return, you don't need to do anything because there's no tax. One, when you register not-for-profit, there is some advantages and incentives that come with it. But one of the things you also need to do, and is allowable, an incentive for not-for-profits, is to seek or apply for a tax exemption certificate. So you could actually apply for a tax exemption from KRA, and if that is granted, then there are certain incomes that you have which will then be under the exemption and not subject to tax. Secondly, on whatever is your key income area, as long as that money is used for the benefit of residents of Kenya and spent that way, then that usually does not get taxed. However, as a not-for-profit, you may be running some business activities with either the surplus funds you're having or you just have other revenue lines. Now, if you actually make income on such ventures, that income is actually taxable under the Income Tax Act.
Okay. Okay, so that's interesting. So even as you're running your company limited by guarantee, you could be doing business activities, you're making a surplus. So what if my surplus is going back into doing non-profit work? So I'm doing a business activity, I am earning a surplus, but that surplus that I'm using, I'm not taking it out. I'm not taking it out as a profit. I'm not earning dividends. I'm actually taking that surplus and putting it back into the non-profit work that I'm supposed to do. So how does someone structure that?
Yes.
From a tax perspective?
So usually, as long as whatever you're generating then is getting consumed by the activities that you're running, it will actually mean that you technically do not have a surplus to be applied to tax. If the surplus does exist, then it will be subject to tax. So the key thing is to ensure that whatever you're generating, then you are actually putting it into the activities you're registered to do, so that then you are not really generating a surplus. You're basically putting it all back into operations.
Okay, right. So I think even from this conversation, personally I'm learning a lot. I hope everybody else is. So the things I've come out of here with is 10 to 35% tax for individuals, which now would be sole proprietors, partners, and partnerships or LLPs, and then corporate tax 30%. And then non-profits, you need to be clear as to how you're a non-profit. You cannot just assume the blanket non-profit, and in the meantime, you're running business activities.
Yeah, that's true. For non-profit, there's even examples of where some of the funds that non-profits get as even grants or sponsorships, donations, because they're not utilizing this money at one go. They put this money in a fixed deposit account and it earns them interest. Now that interest is taxable, and you need to pay tax on that. So there's actually tax payable by these not-for-profits depending on what the income is.
Yes. So it's not a blanket, I shall not pay tax. It is there.
No, a not-for-profit registration is not a blanket guarantee that there's no tax.
Okay. I think that really clarifies a lot of things for me, and I'm sure for all of anyone who's watching. And it's good for us to know that these are now the obligations that you need to have. So in the next episode, we'll be talking more about legal and tax compliance. So please join in and remember to like, share, and follow so that you can see more of this content.